So it never really occurred to us here at Stock Trades, with us being primarily individual stock pickers, that some investors might be looking to take a more passive route but still want to be self-directed investors. They don't want to pay their bank fees, they don't want to pay an advisor fees, but they don't want to take the risk of being wrong picking individual stocks. So index funds are a great way to avoid this, and in this video I'm going to give you the best guide you will find on anything index fund. We're going to talk about what an index fund is, the advantages, the disadvantages, how you can buy them, if they're better than stocks, how they exactly track an index. This is simply going to be a guide that, as a beginner investor, especially one that's looking to get into index funds, you are not going to want to miss. So let's get started. So before we start, if you like the guide, if you like the channel, head down below, like the video, subscribe to the channel. We bring you a ton of investment related content, and I promise you, you're going to love a subscription here at Stock Trades. So index funds, what exactly is an index fund? And an index fund is essentially a basket of stocks or assets that aim to track a particular index. Now, we will go over what exactly an index is in this video, but for now, just understand that an index fund essentially aims to track a broader index through being an ETF, an exchange traded fund, or a mutual fund. And if you want an excellent guide on the difference between those, I'll put a link up in the top of the video here and down in the description. I made a great video highlighting the differences between a ETF index fund and a mutual fund index fund. So obviously, if an index fund is something that tracks an index, it might be wise to learn what an index is. And more than likely, if you have any idea about the stock market, you've probably seen an index before. We have indexes like the S&P 500, the New York Stock Exchange, the TSX, the NASDAQ. And what an index essentially is a performance measure on the underlying stocks within that index. So for example, the TSX 60 index aims to track the performance of the 60 largest stocks on the TSX, while the S&P 500 aims to track the 500 largest companies, publicly traded companies in the United States. So these indexes give us a generic idea of how the stock market might have moved that day. But in the newer age of investing, they've developed products that essentially can allow you to replicate at least pretty close to the returns of that index. So if the S&P 500 goes up by 2% in a single day, if you own SPY, which is the index fund that tracks the S&P 500, you'll likely go up pretty close to 2% on that day. A stock market index can carry a wide variety of stocks. For example, the TSX has over 1,500 companies inside of it, while the New York Stock Exchange has over 2,800. But then, as I mentioned before, you have the S&P 500, which is only 500 companies, and even less the Dow Jones, which tracks the 30 largest companies in the United States, only has 30 stocks. There's also very specific indexes both in Canada and the United States. For example, there is a TSX Technology Index that aims to track the returns of the largest tech companies here in Canada, and you can buy an index fund that tracks this index under the ticker XIT.TO. So then how does an index fund work? And it's a little bit different depending on if it's a mutual fund index fund or an ETF index fund. But on this, I'll speak on the ETF variant. So the managers of an ETF who want to track a particular index will essentially buy all the stocks within that index. So on the TSX, they might buy all 1,500 stocks, and then they issue units of that ETF for investors to buy and sell. As those underlying shares, the 1,500 stocks, move up and down, with it, so does your index fund. Now, there are different ways to replicate an index. The fund doesn't actually need to buy all 1,500 shares. They can do something that is called sampling, where they take a smaller batch to replicate the index. But that's something for another video. For now, you just need to understand that these funds, these ETFs, are purchasing the underlying asset, being the index. They're distributing the units to you, and you buy those units, and in return you get the replication of that index. So you buy your first index fund, you buy an S&P 500 index fund, a year goes by and the S&P gains 10%, but you only gain 9.8%. What gives exactly? And that's something that we call tracking error. Tracking error is essentially the difference between the return of your index fund and the return of the underlying index. So why might they be different? Well, if you look at the way an ETF or a mutual fund is structured as an index fund, there's particular fees and transaction costs that come from running a fund like this. And in the end, the fund does have to pay these, and they will come out of the fund's total returns. So they call this tracking error. The larger index funds will ultimately have less tracking error. The lower the sample size as well, the more potential for tracking error. But ultimately, there is going to be a little bit of a difference between the index's returns and your index fund's returns. So don't be surprised if you return a little bit less. So can you ever return more? Unfortunately, you can't. There is particular ETFs called leveraged ETFs that can allow you to return more than the index. But as a beginner, this is way beyond the scope of this video, and it's something that you need to learn down the line. So there's also the question of, can I lose money in index funds? As a beginner, a lot of people tell you, hey, the path to riches is index funds, passive investing. But the end result is, if an index falls, you fall with that index. So absolutely, it is possible to lose money in an index fund. Now, over the long run, the stock market has been a proven, reliable investment vehicle to generate wealth for people who choose to invest in it. But that doesn't necessarily mean that over the short term, the money you invested will not go down. And if you end up making a mistake and selling a fund at a loss, there is a real chance that an index fund could lose money for you. So index funds are best purchased to make money over the long term. We can't stress that enough. So another question we get all the time is, are index funds better than stocks? And the answer to this question really can't be answered in this YouTube video, especially because it depends so much on the individual investor. In my opinion, being an individual stock picker, yes, I feel that picking individual stocks for me is better than index funds, even though I still do use index funds when investing in international markets. But for somebody who doesn't have the time or knowledge to monitor quarterly reports, study the markets, things like that, I do it all day, every day. Passive investing through index funds is probably a wiser option than purchasing individual stocks for you. But there is a lot of investors who want to outperform the market, and as a result, they go the individual stock route. This isn't going to be a video that's going to try and tell you what is right or wrong. They are both well suited for particular types of investors. So a lot of beginner investors also ask me if index funds can make them rich. And the ultimate answer is absolutely they can. Index funds over the long term with steady contributions and leaving the money alone and letting it grow will, no question, make you rich over the course of time, over the next 20, 30 years. The primary reason why people don't gain long-standing wealth in the stock market is they simply don't have the patience for it. They don't like to see their money grow at 8 to 10% a year. They want to take a shot at more speculative options. They want to try to double their money. They want to try to get rich quick. And index funds will not make you rich quickly. So to show the compounding effect of an index fund, and in fact just an investment in general, I'll use a few examples. So let's go about as far-fetched as we can get and suggest that the TSX ends up gaining 20% annually over the next 5 years. If you were to have invested $100,000 into an index fund that tracks the TSX, after 5 years, you'd be sitting with about $248,832. Now, earning that $148,000 over the 5-year period while earning 20% a year, those are some pretty big returns, but you still aren't rich. And this is in even some crazy market returns, 20% annually. You're going to make about 5 to 8% on that money over the course of the year in an index fund. So if we look at it in that way, the index fund is going to earn you, say, 8% annually, resulting in a 5-year value of $146,932 if you had $100,000 invested. So that is drastically lower than the 20% returns. But if we take this 8% annually and extend it out over 30 years, your value without contributing even another dollar would be worth over $1 million. So as you can see, over a 5-year period, you've only earned about $46,000. But as we begin to earn more and that money begins to compound, your returns as well compound. And over 30 years with $100,000 invested, you're officially a millionaire earning 8% a year. And that's also if you contribute nothing else. In your early years, you might not be able to, but as you get older, you have less debt, less obligations. You're going to be able to contribute more money to your account. And in the end, this could end up being a lot more than $1 million. So another very common misconception by beginner investors who are looking to invest in index funds is the fact that they hear lots about dividend investing being the true path to financial freedom, being able to live off dividends, things like that. So they see an index fund and they don't think that it pays dividend, which is incorrect. Index funds do pay distributions. Now, the distribution varies drastically between index funds, but an ETF index fund pays a distribution much like a stock. They just don't call it a dividend. It's more so called a distribution because there can be capital gains along with dividends inside of what they pay you. So if we look at a specific index fund here in Canada, we can see that they have the iShares S&P TSX Canadian Dividend Aristocrats Index ETF. This index fund aims to track all of the Canadian Dividend Aristocrats, and as you can see, it yields in the high 3% range. Typically with an index fund, although it is never guaranteed, they often pay a monthly distribution. So with a stock, the majority of the time you're going to get a dividend every single quarter, but check the index fund you're looking to buy because very likely you're going to get paid a monthly distribution. So let's go over some advantages and disadvantages of index funds because ultimately there is both. And the number one advantage I feel for an index fund is the fact that you get instant diversification. Constructing a well-rounded investment portfolio typically takes anywhere from 20 to 30 stocks, and this can simply be overwhelming for many people, especially if they're newer and they don't know how to quickly vet stocks they own to make sure that they're still worth owning. So with an index fund, you can pretty much buy 2 or 3 index funds and have exposure globally. You could buy a index fund here in Canada, one in the United States, and one that tracks all international markets, and you essentially have global exposure in just a few clicks. Another huge advantage of index funds is typically their lower fees. You're never going to find a fund and not have it cost you something. And obviously we have to learn to be okay with this. We have other people managing our investments and we're benefiting off their work. So we need to pay a fee to them. But the thing with index funds is they have significantly lower fees than, say, a regular mutual fund because they're passively managed. And by passively managed, I mean they essentially have to buy the index, and that's essentially all they have to do. They only have to balance the portfolio when the index changes. Whereas with a regular mutual fund, which you'll typically see management fees in excess of 2 to 2.5%, these have active portfolio managers behind them, buying and selling stocks consistently, monitoring the portfolio. It's just way more work. So as I mentioned, you'll pay often over 2% for one of these, whereas an index fund can cost you sometimes 1/20%, like 0.05% annually for that index fund. And finally, tax advantages are huge with an index fund. So with a regular mutual fund, and I'm not going to get into the complexities about it again, but because they have to sell underlying stocks, underlying holdings to pay investors who want to cash out, there ends up being a lot more taxable gains in a mutual fund. Whereas with an ETF index fund, the ETF is actually only selling units. It's not actually buying and selling the underlying assets. And as such, there's a lot less taxable earnings inside of an index fund. As well, because they're tracking the index, they're not as subject to change as a actively managed mutual fund. So the tax implications are way lower. So those are some of the advantages of an index fund, but ultimately there is disadvantages. And one of them being that fees are fees. If we want to take a more designated, more specific approach and say we want to buy an index fund that is tracking technology stocks here in Canada, they have one called XIT. It has a management fee of close to 0.6%. This is not a negligible management fee. So when you're looking for an index fund like this, you have to understand you're going to be paying fees. Whereas if you were to buy the individual stocks, all you would pay is a one-time commission to buy that stock. So again, fees, they end up costing us money. They take money out of your pocket and ultimately can be considered a negative consequence of an index fund. So secondly, you have no control over your holdings. Although you will track the index, you will never outperform the index. So a prime example, if you owned a TSX index fund in 2020, there is a very, very good chance you missed out on some huge gains when it comes to tech stocks here in Canada. And this is because you had no control over your holdings. You own what the index owns, and if the TSX gains 10% in a year, you'll gain just shy of that. That's the way an index fund works. You can't go overweight on a particular sector that you feel will outperform, and you can't get rid of a particular sector that you feel will underperform. This came into effect huge in 2020 because the TSX is made up of a ton of energy stocks. So as a result, it took a significant hit due to COVID-19. And with you owning the whole index, you took that full brunt of the hit. So we know what they are, we know what they track, we know some advantages, we know some disadvantages. So now you want to go buy an index fund. And really the way to do it is just open up a brokerage account like Questrade, like Interactive Brokers, like RBC Direct Investing, and these index funds, ETF index funds, can be bought and sold just like a regular stock. They trade on the markets. You can buy and sell them when the markets are open. And really all it takes is an investment account and some capital to get started buying these. They have tickers just like stocks, and they have live price updates just like stocks. And in fact, for most brokerages these days, they're offering commission-free ETFs, which means you don't even have to pay a commission to buy these index funds, only to sell them. But again, if you're holding them for the long term, you obviously have no intentions of selling them, so consider it a free gift. You get to create an investment account and purchase the index fund, absolutely no money out of your pocket. So overall, I hope you liked the video. I hope this let you know a little bit about index funds, what they are, how they differ from individual stocks, and how only you can decide if they're right for you or if you should be purchasing individual stocks. All I can stress is that if you are going to purchase individual stocks, make sure you dedicate the time not only to researching, and you dedicate the time to learning how to navigate the markets. If you don't have the time, you don't feel you'll ever have the knowledge, index funds are a great way to go about it. And remember, as I mentioned earlier in the video, I use index funds myself. I focus on individual stocks strictly in Canada, and I let index funds do the work for me when I invest in international markets. So hope you liked the video. Smash that like button and subscribe to the channel. Also, drop a comment. Let me know if this video helped so we can make more videos like this. And stay tuned for more great investment content. We'll see you next time.